Good evening, students. So, have you revised the depreciation part? And I've asked you to go on through the sums. Have you gone through it? Have you gone through the questions? Okay, meantime, you reply. We will start with the next topic under PGBP, which is now we are moving towards the allowances and disallowances. We have finished the depreciation entirely. Now we would be moving towards the allowances and disallowances. But I expected you to go through the questions given in the module because that will help you understanding whatever we have discussed so far. Right? Okay. So let's quickly start with this. Now we are moving towards section 36. Section 36 of the PGBP head, right? So let's start with it. Now in section 36, I would divide it into three categories. Let me do this thing. Section 36. Okay. Now in section 36, we have three categories, what we are going to discuss. Employment related, finance related, and others. Are we clear? So we have bifurcated into three particular categories: employment related, finance related, and the others, right? Now first we'll start with the employment related expenditure, which is allowed or disallowed, whatever that is there, we are going to discuss. Now, if you see under section 36, we have the contribution to the to the provident fund by the employer as well as the employee, right? So that's what we are going to discuss first. So under section 36, the first of all, contribution to the provident fund. Or let me discuss one by one in the way 36 is there, right? So that will be easier for you to learn also. So 36(1) first, 36(1)(1), 36(1)(1), which is the deductions provided for the amount of any premium paid in respect of insurance against risk of damage or destruction of stock. So first, 36(1)(1), insurance premium paid for stocks. 36(1)(1) is insurance premium paid for stocks, right? Then that stock should be for the business or profession. So that is deductible. Are we clear? Then we have 36(1)(a). 36(1)(a), which is for the amount of any premium paid by the Federal Milk Cooperative Society. Amount of any premium paid by the Federal Milk Cooperative Society. So That is to keep in force the insurance on the life of the cattle owned by a member of cooperative society, being primary society engaged in supplying the milk raised by its members to such federal cooperative society. Are we clear? So again, that will fall under others. That will fall under others. Give me a minute. So, which one is the second one? The amount of premium paid by a Federal Milk Cooperative Society, 36.1.1a. Premium paid by Federal Milk Cooperative Society against the risk of, or to keep the insurance on the life of cattle, for cattle. So insurance premium paid by Federal Milk Cooperative Society, right? That is 36.1a. Then we have 36.1b. 36.1.1b. This is for the health insurance of the employees. So this will come under employee related. Right. So 36.1.1b. which is for the premium paid by the employer, insurance premium paid by the employer other than in cash for the health of employees, for health of employees. This should be other than in cash. Are we clear? So that is 36.1.1b. Then 36.1.2. 36.1.2 is again sum paid to the employee as bonus or commission for services rendered. 36.1.2 bonus or commission for service rendered. It should not be in the nature of dividend. It should not be payable as dividend or profits. Other than profits or dividend. So bonus should not be in the nature such that it is in the nature of the profits or the dividend, right? Then interest on borrowed capital, 36.1.3. We were discussing it that day also when we were discussing about the capitalization in the actual cost. So it will come in finance related, which is interest on borrowed capital, 36.1.3. Interest on borrowed capital. As I said, it should be for the purpose of business and profession. So if it is borrowed, the provisor says that if it is borrowed for the asset, for acquisition of new asset, then for the period from which the capital was borrowed till the date on which asset was first put to use will not be allowed as deduction. And this is what even explanation 8 to section 43.1 says it. Are we clear? Are we clear? Then 36.1.3a. 3613A, discount on zero coupon bond. Discount on zero coupon bonds. In case of interest, you can write it here. For interest, you can write for capital assets, capitalize till asset put to use. Okay. Then next one is discount on the zero coupon bond. Now, in the case of discount on the zero coupon bond, that shall be amortized or the deduction will be allowed on the pro rata basis in the duration of the life of the bond. Discount on zero coupon bond in pro rata basis over life of the bond. Are we clear? Then contribution to the Provident Fund. 3614. Contribution to the Provident Fund or the superannuation fund or the gratuity fund. Right, so any sum paid by the assessee as an employer by way of contribution. So this is the employer contribution to RPF, recognized provident fund, or superannuation fund, SAF. Right. So that will be allowed as the deduction. That will be allowed as the deduction. Then 3615. I'm first dealing with 4 and 5. 3615 is employer contribution to the gratuity fund. Employer contribution to the gratuity fund for the employees, correct? So that is also allowed as the deduction. Now, understand one thing over here. Understand one thing over here. In respect of, here I'm also linking it with the 43B provision. Okay. So in respect of the employer's contribution to the recognized provident fund or superannuation fund, the deduction will be allowed under 3614 and 3615, but this would be subject to that the amounts are paid before the due date of the filing of return of income. So this is subject to section 43B, which is deduction on the payment basis, meaning allowed if deposited before the due date of filing return of income under section 139(1). Are we clear? Are we clear? Secondly, this is also subject to 3615 is also subject to (40A7). What is 40A7? 40A7 says that no deduction will be allowed for provision made by the employer for payment of gratuity to his employees. So the deduction will not be allowed for the provision made for the gratuity. Deduction will be allowed only when the contribution in actual is made for the gratuity. So if it is just a provision, then 40A7 says that no deduction will be allowed. So it says no deduction for provision to gratuity fund or provision for gratuity fund. Are we clear? Also, the 3614, it says employer contribution to RPF or SAF is allowed. There is section 48(9), which is for the disallowances. It provides that deduction will not be allowed for employers' contribution to unrecognized or unapproved gratuity or provident fund or superannuation fund. So no deduction for contribution to or employer contribution to unrecognized provident fund, gratuity fund or superannuation fund. Are we clear? Finally, one more provision which I am linking over here is 40 small a 4, which provides that the employer contribution to the provident fund or the employer contribution will be allowed employer contribution shall be allowed only after effective arrangement has been made to deduct TDS. Has been made to deduct TDS, right? Has been made to deduct the TDS on any payment made from such provident fund to the employee. Are we clear? So see, 3614 and 3615, if you read it in isolation, then these provisions will not be linkable. So it's subject to 43B that you should have deposited the amounts before the due date of filing of return of income. Only then the deduction will be allowed. 40A7 says that deduction will not be for the provision but for the actual payment made, and that is under 3615. So if it is just a provision, you will disallow it. Then 40A9 says that unrecognized will not be allowed as deduction. And 40A4 says that if any payment is made from the PF to the employee, then the employer has to make the effective arrangements for deducting the TDS, else the expenditure will get disallowed. Are we clear? Even in respect of bonus or commission, even in respect of bonus or commission where the bonus is paid to the employee, right, which is not in the nature of the dividend or profit, right, that is also subject to 43B. This is also subject to 43B. So it should have been paid before the due date of filing the return of income under 139(1). Secondly, it is also subject to 40A2, 40 capital A2, which is payment to the related party. So if the expense is paid to a related party, then it should not have been unreasonable or excessive. Otherwise, the excess part over the fair market value will be disallowed. Are we clear? Any doubt? Any questions? Any doubt? Any questions? Okay. Here, in the context of the bonus or commission, I would like to discuss one case with you. So, this was in the context of a Supreme Court ruling in Shasan Chemicals and Drugs Limited. This is a Supreme Court ruling. So, in this case, the assessee had paid the bonus due to the employees to a trust. So, assessee, employer paid the bonus of employees to trust, and then subsequently trust paid to the employees, right, before the due date of 139(1). Right. So the question was whether it can be allowed as the deduction to the assessee. So Supreme Court in Shasan Chemical and Drugs Limited held that the deduction of bonus will be allowed under section 36(1)(3) by considering that the bonus was ultimately paid to the employees by the trust. So Supreme Court allowed it as it was eventually paid to the employees before the due date of 139(1) by applying substance over form approach. Are we clear? So it applies the substance over form test. Clear? In doubt? Okay. Then 36(1)(5)(a). Now we are moving towards 36(1)(5)(1)(5)(a). And in 36(1)(5)(a), what does it say? It is about section 36(1)(5)(a). This is amount received by the assessee as employees' contribution towards the welfare fund. So this is employees' contribution to the PF or whatever fund, ESIC, superannuation fund, right? Or pension fund, whatever, right? Or any welfare fund. So this is allowed as deduction. This is also allowed as deduction only when the amount is paid by the assessee before the due date of the fund. Allowed if amount deposited before the due date of the fund and not the due date of return of income under section 139(1). So remember this thing that for the employee contribution, it has to be deposited before the due date of the fund. And for the employer contribution, it can be deposited before the due date of filing the return of income. So an amendment has been made under section 43B regarding the allowability of expenditure on the actual payment basis, right? So in that particular case, an amendment has been made because certain high courts had given the ruling that even the employee's contribution would be subject to 43B. So in order to overturn that ruling, the amendment has been made even under section 43B, which is now important for your attempt, right? Which clearly provides that it has been clarified that this particular sum will not be included under 43B. So it has been clarified that the provisions of 43B will not apply to the employee's contribution received by the employer. So the extended time up to the due date of filing of return of income is not available for the employee's contribution. Are we clear? Any doubts? Any questions? Any doubt? So amendment has been made under section 36(1)(5)(a) itself by introducing an explanation to clarify that provision of 43B will not be applicable. Are we clear? So here you can write down section 43B not applicable. Then 36(1)(4)(a). 36(1)(4)(a). This is any sum paid by the assessee as an employer's contribution towards the pension scheme. So this is for the employer contribution to the pension scheme. Under section 80 CCD. Pension scheme under section 80 CCD. Here it is restricted to the deduction is restricted to 10% of salary. Salary means what? Basic plus DA, right? 10% of the salary of employee. So 36(1)(4)(a) restricts the deduction to the 10% of the salary of the employee. Salary means salary plus DA. Are we clear? Then 36(1)(6), which is there, which is again not relating to the employees, but it's an other expense, right? So 36(1)(6) is in respect of animals which have been used for the purpose of business or profession other than use in stock and trade, which have become useless or have died. Then the difference between the actual cost of the animals and amount realized in respect of carcasses or animals will be allowed as deduction. Okay, so that's something which is a very small deduction which is there. You can write it here only. 36(1)(6). Deduction of animals died or became useless. Okay, so the deduction is actual cost minus amount realized. Are we clear? Are we clear? Then this is very important. 36(1)(7). Section 36(1)(7), bad debts. Now, bad debts are allowed in the year. Deduction for the bad debts is allowed in the year in which debt has been written off as irrecoverable in the accounts of assessee. Okay, so bad debts are allowed as a deduction in the year in which the accounts of the assessee are written off as irrecoverable in the accounts of the assessee. Are we clear? Any doubt? Now, it could so happen. So understand this very carefully. So see, it could so happen that the bad debts which are there, the income should have been offered to tax, right? The income should have been offered to the tax, and that's why we are saying now if the debts have become irrecoverable, we will allow you the deduction for the bad debts. Now, as I said, it could happen that the income was offered to tax by one particular taxpayer. And now the business is being succeeded by. Now the business has been succeeded by, and now the income could be of the another taxpayer. Sorry, the bad debts could be of another taxpayer because of the succession of the business. Right? So it is possible that one particular taxpayer had offered the income, but it is being succeeded by another taxpayer. So the question arises that the assessee, whether he would be allowed the deduction of the bad debts, the successor. So in this context, Supreme Court, in the case of T. Veerbhadra Rao, K. Koteshwara Rao, had held that the deduction of a bad debt is a deduction to the business and not to the assessee per se. Is not to the assessee per se. So if we read 36(1)(7), it says that amount of bad debt which is written off as irrecoverable. It's not saying bad debt of the assessee. It is a bad debt of a business. So deduction of bad debt is a deduction to the business, and hence bad debts of the predecessor can be written off and claimed by the successor if it becomes irrecoverable after the successor has taken over. Are we clear? So just write it down here. Bad debts of the predecessor can be written off by the successor. Supreme Court in T. Veerbhadra Rao K. Koteshwara Rao. Are we clear? Are we clear? The only difference is in terms of, I'll tell you. So the bad debts should have been taken into income of the earlier years, right? And that is why the bad debts are allowed to you now. Now, there is a section 41.2. There is a section, 41.4, which is for the income. What does 41.4 says? Let me tell you. So 41.4 says that the profit which are chargeable to tax, these are the deemed profits, right? So it says that where a deduction has been allowed in respect of a bad debt under section 36(1)(7, and then amount is subsequently recovered on such bad debt, and then if the amount is recovered on such debt, then let's say the deduction was allowed to the predecessor, and now the business has been taken over by the successor. So whether the recovery can be taxed in the hands of the successor? Whether the recovery can be taxed in the hands of the successor, that is the question. So the bad debts were claimed by the predecessor. Understand this very carefully. But the recovery of those bad debts has happened by the successor. So the question is that whether the successor would be taxable on that recovery. So in that context, there is again a Supreme Court ruling of P.K. Camel. There's a Supreme Court ruling of P.K. Camel. And in that case, which is an old ruling, it was held that if you compare the Koteshwara Rao, if you compare the Koteshwara Rao case, so in that case, it has been held that the one who has offered the income may not be the same as one who is incurring the bad debts, because the bad debts are of business. But in this particular case, in P.K. Camel, in the case of, you can write it down here, recovery of bad debts by the successor, where deduction of bad debts allowed to predecessor. So Madras High Court in P.K. Camel held 41.4 will not be applicable in the case of the successor. So subsequent realization will not be accessible under 41.4 in the hands of the successor. In hands of the successor. Are we clear? Because it held so on the basis that for 41.4, the identity of the assessee must remain the same. So the assessee who enjoyed the benefit of allowance had to be there to invoke 41.4. If Now the assessee is no more there. Then in that case, one cannot claim the, one cannot tax him under 41(4). Are we clear? Similarly, very recently, again Madras High Court in the case of Sundaram Finance Limited. Sundaram Finance Limited had held that where the assessee company recovered the bad debt of the earlier amalgamated companies, which was written off by the amalgamated companies. It's a very recent ruling. The AO had invoked the provisions of 41(4), taxing the bad debt recovery in the hands of the amalgamated companies. Right? There, it was noted that the recovery of a debt was a right transferred along with many other rights which were transferred during the amalgamation. There, in fact, in this particular ruling, they distinguished the PK Camel ruling and they held that 41(4) will also be applied in the case of the successor company. So there they held that the recovery of the debt is a right transferred along with the numerous other rights. And if the law permits the transferor to deduct the debt, then in that case, the successor should be taxed for that. Are we clear? So there are conflicting rulings in that regard. There are conflicting. This was the old ruling, but the new ruling is in the favor of the revenue. So this is the old one. So after the new ruling, this may not be relevant. This may not be relevant after the new ruling. But why did I tell you? Make you understand the rationale. So recovery of bad debts by the successor, where deduction of bad debts were allowed to the predecessor, will be taxable in hands of successor. Write the ruling, Sundaram Finance, Madras High Court. Are we clear? Any doubt? Any question, any doubt? Any doubt? Okay. Yes, there are doubt. Yes, PK Gamal is not applicable, Vinay Kumar. This was just to explain you the rationale. I mentioned it. Are we clear? Any other question? Okay. So now moving further, as I said, that in the context of bad debts, the successor will be allowed the deduction also and will be taxed also. Right? Now understand one thing very carefully. That in the context of bad debt, in the context of the bad debts, one thing we should remember is that, let's say, for example, that the income was offered to tax as per the ICDS and not as per the books of accounts. Quite possible, right? So it is quite possible that the income was offered to tax as per the ICDS, right? Because some ICDS require the recognition of an income at an earlier point of time than as recognized in the books of accounts. So amount of debt would have been then taken into consideration in computing the income, because income was taken into consideration as per the ICDS. So therefore, obviously, the debt would have also arisen. Now, if that particular debt has become irrecoverable, so if the amount of the debt has been taken into account, or if the income has been taken into account in computing the income of the assessee on the basis of the ICDS, then deduction will also be allowed in respect of any bad debt which is then written off as irrecoverable. So if a debt which has not been recognized in the books of accounts as per the accounting standard but has been taken into account because the income is recognized as per the ICDS, and now that debt has become irrecoverable, it can be claimed as the bad debts under section 36(1)(7). And it will be deemed that the debt has been written off as irrecoverable. Are we clear? So you can write it down, this one. So if income is considered as per ICDS and debt is not recognized as per books of accounts and has become irrecoverable, then deduction allowed. Then the deduction is allowed and it shall be deemed as bad debt written off. Are we clear? Are we clear? So what is the only condition for the write-off of the bad debt? The condition for this is debt is in respect of business or profession and it should have formed part of income. It should have formed part of the income. Are we clear? Then, last particular point here in the bad debt, which is the deduction of the differential amount of debt in the year of recovery, which is the deficiency. So, Remember that day we were dealing with the terminal depreciation. We were dealing with the terminal depreciation. In the similar fashion, we have the deficiency even under the bad debt in the year of recovery, which is deduction under section 36(2). So in the year of recovery, if on the final settlement, the amount is recovered in respect of debt, so where the deduction has already been allowed, right? Where the deduction has already been allowed, so then in the year of recovery, if your debt due minus the debt allowed after considering the bad debts minus amount recovered, so the balance shall be allowed as the deficiency. So if the difference between the debt due, what was due to me, and what was actually allowed as bad debts, minus, let's say if the amount recovered is less, what is actually allowed to me, that I have already allowed as a deduction, right? But let's say the amount recovered is still less than what was due minus allowed. Are we clear? So what was disallowed earlier, out of which I have recovered some portion, the balance I can now claim it as a deduction. In the year of the ultimate recovery. Are we clear? That is one. Second, as we were talking about 41(4). So taxability under section 41(4). Again, this is in the year of recovery. In the year of recovery, if a deduction has been allowed earlier of bad debt under 36(1)(7), and now subsequently the amount recovered is more than the amount due after the allowance has been made. So, in the year of recovery, bad debt recovered minus disallowed bad debts, which is again your debt due minus debt allowed. Then in that case, this will be taxable under section 41(4). Are we clear? So as I said, this will also be taxable in the hands of the successor now for the debt deduction, for the bad debt deduction allowed to the predecessor. Are we clear? Any doubt? Any doubt? So, I'm just making a chart over here for the bad debt recovery so that you have it like all at one place. Bad debt recovery. Or let me make it a comprehensive chart for you so that you are able to revise it also during your exam. So bad debts, right? Allowed as deduction under section 36(1)(7). year in which written off as irrecoverable. The two conditions are for the written off, for the deduction is debt in relation to business or profession considered as income. Considered or should have form part of as the income, computation of income. Are we clear? Then debt considered as per ICDS becomes irrecoverable allowed as deduction. Are we clear? Bad debt of predecessor allowed as deduction to successor. E.K. Veerbhadra Rao, Supreme Court. Cited debt of predecessor allowed as deduction to the successor, allowed as bad debts deduction to the successor. If amount recovered subsequently, then bad debts disallowed less than amount recovered, then debt due minus debt allowed, which is your bad debt disallowed, minus amount recovered. Your bad debt amount recovered is greater than your amount recovered, then in that case, amount recovered minus debt due minus debt allowed, which is your bad debts disallowed under section 41(4). Bad debts will be taxable on recovery successor under section 41. Sundar, are we clear? Madras High Court. Any doubt? Aniket, yes, from 2022. Case of 3615A. Paid within due date for 11 months. But 1 month is not paid within due date of 1 month will deduction available for 12 months. So for that will be disallowed, Jacob. Point I forgot telling you in. Okay. Here in 3615A, remember one thing, that this is first considered as income under section 224. So the employee's contribution to the PF or any fund which is there, this is considered first as the income of the employer. So if you read the definition of the income, it specifically includes under 224 10. It says that any sum received by the assessee from his employees as contribution to PF, SAF or any other fund or ESIC, that will be the income of the employer. So if he has deposited within the due date, then to that extent it will be allowed as deduction. So in exam, if you get the question on the employee's contribution, don't consider this as income just because I have written over here. Make your arrow properly. So in the exam, if you get the employee's contribution, then how will you make the presentation in the exam? First, you will write add income under section 224.10. Then, if the amounts are deposited within the due date, you will less deduction under 3615A. So let's say for the month of Feb, I have not deposited within due date. So that automatically will be added to my income. Are we clear? Are we clear about this? So the employee's contribution to the PF is first considered as the income. Clear? Okay. Now I'll take one example for the bed debts. I'll take one example. So let's say for the previous year, 21-22. Bed debts allowed by AO 40,000. Total bed debts 75,000. So out of total bed debts of 75,000, 40,000 is allowed by the AO. In your previous year, 22-23, there was recovery of 44,000. Now tell me what will happen in this particular case. No, Vinay, that's not the correct answer. Yes, now you have given the correct answer. Anybody else? Yes, Aniket, particular portion. You'll get the correct answer there. Rashmi, yes, correct. Yes, Karthik, correct. Okay. So, Aniket, here if you see 75,000 is the total bad debt due, minus 40,000 is the debt allowed. So 25,000, right? Sorry, 35,000, not 25, 35,000. Recovery is 44,000. Now, amount of recovery is greater than your bad debt disallowed, right? So here, if you see, your bad debt disallowed is greater than the, sorry, is less than the amount recovered. So here, what was my total bad debt disallowed? 35,000. 35,000 is the bad debt disallowed to me, which is less than the amount recovered, So in that case, what will happen? My amount recovered is more. So amount recovered, if it is more, then 9,000 will be taxable under 41(4), which is 35,000 minus 44,000. Are we clear? So if here it is, sorry, I have made a mistake over here. Here debt due should be greater than and not less than the amount recovered, and in this case, it should be the reverse thing. Are we clear? So 9,000 is the taxable amount. Did you get it, Aniket? Are we clear? All of us are on the same page? Did you understand this example? Okay. Yes or no? Clear? Okay. Let's proceed further then. Now, provision for bad and doubtful debts under 36(1)(7)(a). Provision for bad and doubtful debts. So in case of the bad debts, the actual bad debts are allowed and not the provision amount. But in case of specified banks, in the case of the specified bank, the provision is allowed for the specified banks. This is only for the specified sector for which the provision is allowed. Other than that, provision for the bad debts is not allowed in case of any other assessee. Be very clear about it. So in case of a scheduled bank, it is, what is the provision which is allowed? So a scheduled bank, for that 8.5% of the total income. 8.5% of the total income. Before making any deduction under Chapter 6A. Before deduction under Chapter 6A. Are we clear? So in case of the scheduled bank, it will be 8.5% of the total income before making any deduction under Chapter 6A. So total income before the deductions. Are we clear? Then, in case of the foreign bank, in case of the foreign bank, how much is the percentage? In case of the foreign bank, it is 5% of the total income. Again, before making the deduction under Chapter 6A. Are we clear? So in case of a foreign bank, it will be 5% of the total income. In case of public financial institution, PFI, or a state financial corporation, again 5% of the total income before making any deduction under Chapter 6A. Finally, in the case of NBFC, again it is 5% of the total income. Also, in the case of a scheduled bank, in case of the advances made by the rural branches, advances made by the rural branches, if there is a rural branch of a scheduled bank, then 10% will be allowed. 10% not of the total income, 10% of the advances by the rural branch. 10% of the advances made by the rural branch. Are we clear? So in case of only scheduled bank, this particular for the rural advances, this is allowed. Are we clear? Any doubt? Any question, any doubt? So amount exceeding 10%, not exceeding 10% of the aggregate advances made by the rural branches. Clear? Any questions, any doubt? Vinay, for the taxation, the provision will be created in this particular manner. This is as per the tax law. This is only for the computation of the income. This is not going to affect your books of account. So the tax computation is different from the books of accounts. The adjustments are made in the return of income annual computation and not your financial statements. So what you are saying for NBFC as per Ind AS, that will not have any impact on the provision as per the tax. As per the tax, the provision will be different from that as per the Ind AS under what you are saying under Ind AS 109. Are you clear? Karthik, I'm not getting a doubt due to classification standard and substandard effects. What do you mean by that? Clear? So for the non-scheduled bank, 8.5% and for the rural advances, 10% of the advance. For foreign bank, public financial institutions, state financial corporations, NBFC, it is 5% of the total income. Clear? Are we clear? Okay. Then this was also under the financial. This was also under the financial. Now the next one under the financial category is, next one under the financial category is in respect of the special deduction to the entities engaged in the eligible business, which is under 36(1)(8). This is in respect of the special deduction to the financial entities. Now, what are the eligible business, first of all, for this deduction, before even we understand what is the deduction? Eligible businesses. So, for the specified entities, for the financial corporation, banking company, financial corporation, banks, cooperative banks, eligible business of providing long-term finance for industrial or agricultural development, development of infrastructure facility, and housing in India, development of housing. Then specified entity is housing finance companies, which are engaged in the business of providing long-term finance for the construction or purchase of residential house, for residential house, and any other financial corporation. These are the specified entities which is engaged in the business of providing long-term finance for development of infra, for infrastructure, right? So in case of these eligible entities or the specified entities engaged in the eligible business, a special deduction is allowed under section 36(1)(8). Deduction for transfer to special reserve. For transfer to special reserve. So these entities are required to have a special reserve, and the amount of deduction for the transfer to the special reserve will be 20% of PGBP, 20% of profits and gains from business or profession, 20% of the amount from the profit derived from the eligible business, amount transferred to the special reserve, amount actually transferred to the special reserve, and 200% of the paid up capital, paid up share capital, and the general reserve less amount transferred to special reserve. Lower of these three amounts will be allowed as the deduction. Lower of these three amounts will be allowed as a deduction. Are we clear? If the amount is withdrawn, withdrawal of amount from special reserve, then the amount withdrawn will be deemed to be the profits and gains. So this will be the deemed income in the previous year in which amount is withdrawn, even if business not in existence. Clear? Clear? So this is deduction of the special reserve. This is deduction for the special reserve. Are we clear? Any doubts? Any question, any doubt? Yes, Karthik, you're correct. But Karthik, in the case of the specified banks for which the provision for doubtful debts is allowed, so for them, they have also an option. They also have an option in respect of only the scheduled bank. The scheduled bank have an option of allowing the deduction in respect of the assets classified as doubtful debts in accordance with the RBI guidelines up to the 5% of the amount of assets shown in the books of accounts. So a scheduled bank or a non-scheduled bank also shall at its option be allowed deduction in respect of any provision already made by it as per the RBI guidelines up to 5% of the amount of assets shown in the books of accounts. Are we clear? Any doubt? Okay. Then the other deduction is in regard to the employee side, employee deduction. These we were discussing about the finance one. Again, for the employees, there's one more deduction which is in respect of the family planning expenditure. So expenditure incurred by the company for the purpose of promoting family planning amongst its employees, which is under 36(1) 9. Deduction for family planning expense. Right? So the expenditure which is of a capital nature, 1/5 of the expenditure will be allowed over the period of the 5 years. So 1/5 of the expenditure will be allowed. This is for the companies only the company assessee. 1/5 of the expenditure over 5 years. In case it's a capital expenditure. Revenue expenditure fully allowed. Revenue expenditure is fully allowed. Are we clear? Any unabsorbed capital expenditure which will be treated like the unabsorbed depreciation. So carry forward and set off as unabsorbed depreciation. Are we clear? Then in case there is amalgamation, right? In case there is amalgamation, then the amalgamated entity is entitled. In case of amalgamation, amalgamated entity will be entitled. Are we clear? Any doubt? Any questions? Any doubt? And in case any capital asset is purchased for family planning, let's say any capital expenditure or any capital asset is created, and if it is disposed of, then what we saw for the balancing charge, remember 41.3? Yesterday we did that, isn't it? So remember we did that for the balancing charge. I'll take you to that. This one. Right? You did that for the balancing charge, right? So in the similar way, or for the even we will see in the scientific research expenditure, which is where the capital asset is purchased. So in case of the family planning expenditure also, where the asset representing expenditure of a capital nature on family planning is sold, right? And the proceeds of the sale exceed the amount of the capital expenditure, then the excess will be chargeable under the 41.3 as deemed income. Are we clear? Are we clear? Okay. Karthik, I'm unable to understand the doubt. Apart from 5% is allowed and further 5%. No, it's only 5%. No further 5%. Okay, so let's take a break of 10-15 minutes and then we get back. Okay. Okay, so any further questions, students? Before we move on further, any further questions? Okay. Then last few are the very, very small deductions, but I'll just discuss it orally. I would not even write it because those are very, very small deductions. Okay, there are a few questions. Okay, let me take it up. Uh, Jacob, you're asking what if amalgamation happens between the period of 5 years? Will the deduction be allowed pro rata basis for both amalgamating and amalgamated company? Yes, you're correct. So until the amalgamation is happening, till that time, the amalgamating company will be allowed, and post that, the amalgamated company will be eligible for that balance period. Clear? Yes, Vinay, it's family planning promotion expenditure only. Jacob, you are asking on page 6.197. Are you referring to the module 6.197? And there the question is, question number 10, whether was sale of bus by state government or corporation. Okay, let me see this question and get back to you. Jacob, you're asking about then again 6.178, which is if Mr. Janak actually sold the obsolete machinery, depreciation on it, whether will it be disallowed. Okay, I'll check that and we'll get back with that particular question because I will have to read what exactly you're asking. Any other question? Okay, so shall we move further? Okay. Karthik, you're asking again about the 8.5%, which is for the uh, provision for doubtful debt. So your doubt is that whether 8.5% expenditure which is there, sorry, the 8.5% provision for doubtful debt is there of total income if the provision is made as per the guideline of RBI. And then 8.5% is allowed and the remaining is disallowed. Yes. So in that case, they have option either to go for that 5% or in that case, they can go for the 8.5% one, which is as per the Income Tax Act. Okay. So they have an option of further deduction of 5% also, which is for that scheduled bank only. So a scheduled bank at its option will be allowed a further deduction of 5%. In that particular case, they have an option to claim that as well. Are you clear? Are we clear about this? Okay. So as I said, for the provision for doubtful debt, I think there are some queries with respect to that. So for the provision for doubtful debt is generally not allowed for other businesses. It is only allowed for the specified bank. In case of the scheduled bank, it is 8.5% of the total income. And if it has the rural advances, then 10% of the aggregate advances. Okay. Then such bank also has at its option be allowed a deduction in respect of provision made by it for any assets classified by the RBI as doubtful assets or loss asset in accordance with the RBI guidelines, an amount of 5% of the assets, which is over and above that 8.5%. Are we clear? Any other question? Any further doubt, any question? Okay, let's proceed further. Okay. Now, as I said, the balance are small sections. What we would be just orally, I would be telling you. I would not be even writing it down. So, these are some of the expenditure for expenditure incurred by entities established under Central Act or State Act. Any expenditure which is incurred by them is allowed as deduction. And secondly, any deduction of contribution by public financial institution to credit guarantee fund for small industries, that is allowed as deduction. Deduction of security transaction tax paid. So STT paid in respect of taxable security transaction entered into the course of business is allowed as deduction under section 36. Mind you, it is not allowed as deduction under the head capital gain. Under the head capital gain, STT is not allowed as deduction, but it will be allowed as deduction under the head PGBP if you have the business income. Similarly, you are allowed the commodity transaction tax as a deduction in respect of commodity trade. Then expenditure incurred by the cooperative society for purchase of sugar cane, that is also allowed as the deduction. Then in respect of, as I said, the securities, in respect of securities, the mark-to-market loss is allowed. So ICDS 1 also provides that the mark-to-market losses will be allowed specifically. So in that context, the mark-to-market losses are allowed in respect of certain ICDS, which is under section 36(17). Are we clear? Are we clear? Any doubt with respect to 36? Any question, any doubt, you can ask me. Else we'll proceed to the another section. So are you clear about the advances, rural advances, and the provision for doubtful debts? Have you understood that? Yes or no? I'll again repeat it once. In respect of PFDD, scheduled bank can claim 8% of the provision for doubtful debts as a provision for doubtful debt. In respect of rural advances, it is 10%. A scheduled bank has the option of claiming the 5% of the this loss assets or the doubtful assets, and in respect of the foreign bank PFI, it is 5%, and even in respect of the NBFC. Clear? Okay. Now moving on further. Okay, moving on further. Next section is in respect of the section 37, which is the residuary provision or the general deduction. Section 37, the general deduction. Are we clear? So, in respect of the general deduction, section 37, what is not allowed specifically under your any other section under 30 to 36 is now allowed under section 37. So, any expenditure which is not covered under 30 to 36. Any expenditure not covered under 30 to 36, not being personal in nature, not being capital in nature, not being prohibited by law or an offense, and wholly and exclusively incurred for business or profession. So section 37 has these following conditions, right? It should be for the purpose of wholly and exclusively for the purpose of carrying on the business or profession. So this is the residuary section which is not specifically covered under 30 to 36. Are we clear? And what are the conditions? The expenditure should have been incurred. It should be for the purpose of business. It should not be personal. It should not be capital. It should not have been prohibited by law. Now, understand one thing. This particular section requires you to have the expenditure wholly and exclusively for the purpose of the business. Expenditure incurred on the keyman insurance policy is allowable as the business expenditure. So CBDT has clarified that the keyman insurance policy is, if it is taken for the partners or if it is taken for the directors, then in that particular case, it will be allowed as a deduction to the firm or to the company. Are we clear? Then there is explanation 1 to section 37(1), which provides that any expenditure which is for the purpose of an offense or prohibited by law shall not be allowed as a deduction or allowance. In that context, a very, very recent and a very important circular which is there, which is regarding the expenditure incurred by the assessee in providing the freebies to the medical practitioners. Expense on providing freebies to medical practitioner. Okay. So if you see that the expenditure, explanation 1 clearly says that the expenditure which is for the offense or which is prohibited by law will not be allowed as the deduction. Earlier there was a circular, now they have made a specific amendment which is applicable for your attempt, which is made by Finance Act 2022, which is they have made a clarificatory and a retrospective amendment to provide that the expenditure incurred by the assessee for any purpose which is an offense or which is prohibited by law would include and would have always deemed to have included, meaning it's a retrospective amendment which is made. So they have clarified the meaning of the term expenditure incurred by the assessee for any purpose which is offense or which is prohibited by law. Explanation 1 to section 37. What does it say? It says expenditure for any purpose which is an offense or which is prohibited by law this will be disallowed or will not be allowed. Clear? And now they have clarified why explanation 3 introduced wide Finance Act 22. What they have clarified? That this expression shall include expenditure for any purpose, which is offense, or which is prohibited by law, for the time being in force in India or outside India. For time being in force, law in India or outside India, meaning that any offense, it should not be the offense only in India, it can be offense outside India also. Are we clear? So it may be prohibited by law in India or even as per the law outside India. Second, I'm just putting it here only. Instead of writing it down, let me just put it here. Verbatim section. Yes, so this is your section. Right? So what does it say? Second, to provide any benefit or perquisite to a person, whether or not carrying on a business or exercising a profession, and acceptance of such benefit or perquisite by person is in violation of any law, rule, regulation, guideline governing the conduct of such person. Third, to compound an offense under any law for the time being in force in India or outside India. So, what is the meaning of compounding? Compounding means that instead of prosecution, you will pay the penalty. Penalty in lieu of prosecution. So, if you have done any offense which is liable for prosecution, then instead of going for prosecution, you compound the offense, then any expenditure for that, for the compounding of offense in India or outside India will be disallowed. But what is more important to me is the second point, which provides that to provide any benefit or perquisite to a person and the acceptance of such benefit is in violation of any law, rule, regulation. So as I was telling you, there was a CBDT circular in respect of the expenditure for providing freebies to the medical practitioner by the pharmaceutical companies. So CBDT had clarified that providing these freebies to the medical practitioner is in violation of the provisions of Indian Medical Council regulations. And therefore, it is the expenditure which is prohibited by law. And therefore, the pharma companies will not be allowed any deduction. The pharma companies will not be allowed any deduction. Because the Supreme Court in the Apex Laboratories case, which is a 2022 case, had held that the incentives given by the pharma companies to doctors had a direct result of influencing the doctors to use those medicines which is not permitted, because they would be under influence to use those medicines. And therefore, the medical practitioners are forbidden from accepting such gifts. Because otherwise, they may recommend you only those medicines, even if those medicines may not be good for you. So, the pharmaceutical companies are prohibited to give such gifts, and so is with the doctors to accept such gifts. And if any expenditure is incurred for that, this is now specifically prohibited under the Income Tax Act. Are we clear? So that is one of the amendment which is made. Clear? Secondly, explanation 2 provides that any expenditure incurred by the assessees on the activities relating to CSR, corporate social responsibility, will not be allowed as the deduction. So any CSR expenditure will also be disallowed. CSR expenditure disallowed. So under section 37(1), you cannot claim any CSR expenditure. Are we clear? Advertisements in souvenirs of the political parties. Again, that is disallowed. In souvenirs of political parties. It is disallowed under section 37 2B. So that is not allowed as the deduction. Are we clear? Traveling expense of the spouse of the managing director. Traveling expense of the spouse of the managing director. In several decisions, it has been held that this is for the business of the assessee, because it is customary practice to also provide the traveling expense for the spouse of the managing director. And therefore, that is considered as the business expense. Any fines and penalties. Any fines and penalties will not be allowed as deduction, because they are the expenses which are as the offense, which are for the offense, right? So that will not be allowed as deduction. So penalty on sales tax, penalty under income tax will not be allowed. Yes, penalty under contractual liability may be allowed. So penalty which is incurred as a part of, let's say, if I have not provided the goods on time and the contract say that I'll be liable for penalty, that will be allowed. But if it is a statutory liability, that will not be allowed as deduction. Are we clear? Interest on sales tax is allowed. Interest on income tax is not allowed as the deduction. Legal cost for the cases which are going pending in the court, that is also allowed as deduction. Legal cost for income tax proceedings, again, that is allowed as a deduction. Are we clear? Any doubt? Any doubt? Okay. Then, few other points over here which are very, very important. Fine and penalties, Karthik, to the custom and GST will not be allowed. CSR is not considered as the business expenditure. It is for the it's not for the benefit of the business. It's a compulsory obligation which they have to do, and therefore it's kind of the application of the funds and not considered as the business expense. Are we clear? Interest on GST, yes, allowed as the deduction. Interest on GST allowed. So interest on GST allowed. Penalties under GST or custom not allowed. Interest on TDS or income tax is not allowed. Penalties under income tax not allowed. Legal fees allowed. Penalties in contractual obligation allowed. Are we clear? Okay. Now, last few things. So there are a few case laws which I would want to discuss with you. So this is the case of, there are three cases. One is in respect of the expenses on the issue of the share capital. These questions come in the exam as adjustment, so you should know about it. Expenses on issue of the share capital. Whether these are the capital expenditure or revenue expenditure. So, Supreme Court, in the case of Brook Bond India Limited, has held that the share issue expenses are capital in nature and they will not be allowed as deduction because expenditure are incurred for an enduring benefit as expense for enduring benefit, and this is in the capital field. So shares issued by the company are the capital of the company, right? And being an integral part of the permanent structure of the company, permanent capital structure of the company, this expense also relates to the capital expenditure. Therefore, any fee paid to the registrar for expansion of the capital or issue of the new capital is the capital expenditure, and this particular expenditure would, even though help in the business of the company, but it retains the character of the capital expenditure, and therefore this will be not allowed as the deduction. Are we clear? Second case, expense on the bonus issue. Now, with the same logic, you may say that, ma'am, bonus issue is also a capital expenditure and therefore it is not allowed as deduction. But no. So, in the context of General Insurance Corporation, in the case of General Insurance Corporation, the court has held that the share issue expenses will be the revenue expense in case of bonus issue. Why it has held that in such a manner? You may say that, ma'am, for the capital issue, you are saying that it's a capital expenditure. For bonus issue, you are saying it's a revenue expenditure. Why? Because expense incurred by the company on the bonus issue is not of the capital nature, as the issue of the bonus shares does not result in the inflow of the fresh funds or increase in the capital employed. The capital employed remains the same. Issuance of the bonus shares is just the reallocation of the company's funds, which does not result in expansion of the capital base, nor does it result in the benefit of the enduring nature. The total funds of the company remains the same in case of the bonus share. So it does not change the capital structure of the company, and hence these expenditure are revenue in nature, as it does not change the capital structure. And the last one, expenditure on the issue of debentures. Expenditure on the issue of debentures. So expenditure on issue of debentures, since it's not a part of the capital structure, this will be revenue expense, even if debentures are convertible debentures. Why? Because they are debentures at this point in time. They may be converted to equity at a later point, but at this moment they are debentures. Are we clear? Okay, so we'll quickly move ahead to the next section, to section 40. We'll quickly move ahead to section 40. But before that, I'll just discuss one small circular with you, which is in the context of the build, operate, and transfer. Which is in the context of build, operate, and transfer. Now I'll directly take this circular and then we'll move to section 40. So, CBDT has issued a clarification regarding the treatment of expenditure incurred for development of roads or highways in build, operate, transfer agreement. Now, what are these agreements? So, see, these are the projects, build, operate, and transfer, which are entered between the developer and the government. So, in these kind of projects, the developer enters into a concessionaire agreement with the government, wherein the developer is required to construct, develop, and maintain the infrastructure facility of roads or highways. So government with the private contractors enter into such kind of concessionaire agreement, wherein the developers are required to develop and maintain the infrastructure facility of road or highways, so at their own cost. And then in this particular case, how this particular developing rights and all these are transferred. So first, the possession of the land is handed over to the developer by the government. The land is owned by the government, right? The government will transfer the land to the developer for the purpose of construction of the project. But the ownership will remain with the government. The assessee only gets a right to develop and maintain the asset. It then, once it develops the asset, it enjoys the benefits from the using of the asset also through the collection of the toll. So the assessee will get the land rights to develop the road or highway on that particular land or the bridges on that particular land. The ownership lies with the government. The ownership is not transferred. The possession of the land is transferred for the purpose of developing the bridge, highway, whatever on that. And the assessee will be entitled to the toll which is generated from that particular use of that highway. So since the assessee is not entitled to the ownership, the assessee is not owning the land, the assessee also does not have any rights in the project except the recovery of the toll fee to recover its expenditure. It is not the owner of the property and therefore it is also not entitled to the depreciation under 32. Because assessee is not the owner. Right? Further, the expenditure which the assessee is incurring for the development of road or highways, that particular expenditure is for the enduring benefit. So that will be a capital expenditure. Correct? So since the assessee is getting a continuing benefit over a period of time, this particular expenditure will be allowed to be spread during the tenure of the commissioner arrangement. So CBDT has clarified this only, that the cost of construction of the roads or highways will be amortized and claimed as the allowable business expenditure over the life of that concessionaire arrangement. Are we clear? So you can just write it down over here. In case of bought, build, operate, and transfer arrangements, I can make a diagram for you. Government, grants, possession of land. It owns the land and the project. Right? There is this developer who will develop highway. Right? It will enter into a concessionaire agreement. Right? So, entitled to toll. Not entitled to depreciation as not owner. Expenditure on development to be amortized over the agreement period. CBDT circular. Are we clear? Any questions? Vinay, debt does not change the capital structure. Debt is never the part of capital structure. Capital structure is your equity and preference, not the debentures. Clear, Vinay? Okay. Now, moving towards section 40. So, 36 was your deductions. 40 is now in respect of the disallowable or inadmissible deductions. $36 was your admissible deduction. 40 is inadmissible deductions. So what are the expenditure which are not deductible? This I will be going very, very quickly, right? So first is 40A1. Interest, royalties, fees for technical services, or any other sum chargeable to Income Tax Act. Which are paid or payable to the non-resident, right? On which TDS has not been deducted or has not been paid on or before the due date of filing return of income. So TDS is not deducted or deducted but not paid before your due date of 139(1). Then in that case, the expenditure will be disallowed to you. The expenditure will be disallowed. Are we clear? So in case the TDS has not been deducted or deducted but not paid, then in that case, the expenditure will be disallowed under 40A1. There is a proviso to 40A1 which says that in respect of any sum, tax has been deducted in a subsequent year or has been deducted during the previous year but paid after the due date, then the deduction will be allowed in the year in which the tax has been paid. So deduction will be allowed in the year in which the tax is being paid. Are we clear? So deduction in previous year when TDS deposited. Clear? There is second proviso to 40A1 which says that where the assessee fails to deduct the whole or part of the tax, where the assessee has failed to deduct the TDS, in that particular case, the assessee is treated as the assessee in default. So, not only the expenditure is disallowed, but assessee will also be treated as assessee in default under section 2011. Right? Under section 2011. And if the assessee is treated as assessee in default, then the interest consequences will be followed. Correct? But there is a proviso to section 2011 which says that if a person has not deducted the TDS, then he will not be treated as assessee in default if he has furnished the return of income under 139. If the payee has furnished the return of income under 139 and the return, the payee has taken the income into consideration and has paid the tax on that income and furnishes a CA certificate, then the payer will not be treated as assessee in default. So exception to this is payer not to be treated as assessee in default. Payer not to be treated as assessee in default if payee has furnished ITR or return of income under section 139. It's not 139(1), it just says 139. It may be belated, it may be revised, it may be a normal return. Whichever one is fine. Has taken into account income in the return of income, has paid the taxes on income, furnishes CA certificate, furnishes a CA certificate regarding this, then the payer will not be treated as assessee in default. Are we clear? Also, under 48, if the assessee is not to be treated as assessee in default, then the disallowance also will not be paid there. Then the disallowance also will not be there. But when the the allowance will be there and not the disallowance. So if the assessee is not treated as assessee in default, then in that particular case, the expenditure will not be disallowed to the payer, right? Disallowance will not be made to the payer, provided the return is furnished in that particular year itself by the payee. So let's say, for example, if I have paid the expenditure of royalties, or let's say I paid the expenditure of interest in previous year 2022-23. But let's say I have not deducted the TDS on that particular interest paid to non-resident. Now the non-resident is not furnishing the return during the previous year 22-23. He is furnishing the return in, let's say, next year declaring that income. So in this year, the disallowance will be made, and the next year, I will be allowed the expense as deduction when the return is furnished. So when the return is furnished, in that particular year, the deduction will be allowed, and not the year in which the non-resident has not furnished. So when the non-resident will furnish the return in that particular year, I will be allowed the deduction. Clear? Any doubt? The CA has to certify the form as per which rule? Is this as per 201? It's not as per the rule, it's as per 201 section. So 2011 only says that the CA has to give the form in form 26A. Clear, Karthik? Karthik, section 38 is for the building, partly used for business and partly used for the non-business purpose, right? So if the building is not exclusively used for business and it is used partly for business, partly let's say for the residential purpose, then as I had explained to you earlier also that in that particular case, the proportionate expenses will be allowed as deduction in terms of the rent, in terms of the insurance which is paid, in terms of the municipal taxes which are paid, that proportionate expenses will be allowed. Are we clear? So that is in respect of the building, or even for that matter, plant or machinery. So that is section 38, which is very simple. Again, in terms of section 39, 39 is for the managing agency commission, which is omitted. 39 section is now no more there as a part of the Income Tax Act. Clear, Karthik? Pre-incorporation expense, Jacob, will not be allowed as deduction. Only in a specified case it is allowed, which is what we are going to learn in the next class, 35D. That's what we are going to learn. Okay. Are we clear? So 40A1, very much clear. Okay. Then 40A1A. 40A1A. Okay, just write it over here. Deduction allowed when ITR. Deduction allowed in the year ITR furnished by pay. Are we clear? Are we clear? Okay. 40A1A, if in this particular case TDS not deducted, let me just put it here, the section itself for you. Okay. So 40A1A, 30% of the sum payable to a resident. This was for the non-resident, right? 40A1 was for non-resident. 40A1A is for the resident. So 30% of the expenditure is disallowed if the tax is deductible and has not been deducted, or if it has been deducted but not paid on or before the due date under 139(1). And it will be allowed when the expenditure, 30% of the expenditure will be allowed as deduction in the previous year in which the tax has been paid. Similarly, here also 2011 will be applicable, where the assessee has, where the payee has furnished the ITR, has taken the income into the account, has paid the taxes, has furnished the CA certificate. Then in that case, it will be deemed that the assessee has deducted and paid the tax on the sum on the date of furnishing the return of income by the payee. Are we clear? So 40A1, 100% of the expenditure is disallowed, and 40A1A, only 30% of the expenditure is disallowed. You can write it over here. 100% expenditure disallowed in 40A1. Whereas in 40A2, it is only the 40A1A, it is only the 30% of the expenditure which is disallowed. Are we clear? Any doubt? Any doubt? Okay. Then moving ahead, 40A1B. 40A1B is in respect of equalization levy. So any consideration which is paid, any expenditure which is there, where the equalization levy is not deducted or deducted but not paid. So on which equalization levy is deductible, has not been deducted or has not been paid on or before the 139(1) due date. Then in that case, that expenditure, 100% of expenditure will be disallowed. Are we clear? And this will be allowed in the year in which the levy has been finally paid. Clear? Now, there is one particular point which I would like to discuss over here, especially in the context of 40A1 and 1B, oh sorry, 1A, which is, so there was a particular question before the Supreme Court that whether in case of 40A1, do we have to, or even in case of 40A1A, do we have to deduct the TDS only when the sum is paid, or even when the sum is payable, we need to deduct the TDS? So that was what the question before the Supreme Court was. In that particular case, what do you think? Whether 40A1 will be taken when the sum is paid or only when the sum is payable also? What do you think? From where do you get 194R, Karthik? I didn't understand that. So paid or payable? What do you think? So Supreme Court in the case of Palam Gas Service Limited, 2017 decision, very recent one, has held that provisions of section 40A1A shall apply to paid as well as payable. Paid as well as payable. So if you see 40A1A, it says that paid as well as payable both will be included. Are we clear? So it's not only the term paid, but even payable will also get included. So it will apply to both cash as well as the mercantile assessees following mercantile system of accounting. Clear? So that was the Supreme Court decision. Yes, Checo, pay as well as payable both. It's not only paid, but as well as the payable. Clear? Any other doubt? Okay. Then we are moving towards, so payable as well as paid, both will be covered. Payable occurring in 40A1A. So if you see here 40A1A, it says 30% of any sum payable to a resident. So payable will cover the cases where the amount is yet to be paid, but also where the amount has actually been paid. Are we clear? So 40A1, even though it covers the term only payable, but even where the amount is paid, that also will be covered. Because the question before the Supreme Court was that where the sum is paid, it is not accrued, and where the TDS has not been deducted, whether there also the disallowance will be there, the answer is yes. Even if you have accrued or if you have paid also, the disallowance would still be there if you have not deducted TDS. Clear? Okay. Then 40A 1B, then 48 2. 48 2 is 48 2. This is in respect of any rate or tax levied on PGBP. So any rate or tax levied on the PGBP will be disallowed. What does it say? Any sum paid on account of any rate or tax levied on PGBP will be disallowed. So this includes even any sum eligible for relief under section 90, which is the foreign tax credit. So any foreign tax will also be not allowed as the deduction. Are we clear? And now this amendment, as you can see in italic, this is the recent amendment, which is that for the removal of doubts, it is hereby clarified that the term tax shall include surcharge or cess, because some of the high courts had ruled that education cess or surcharge will be allowed as the deduction. Some of the high courts had ruled that. And in order to overrule that decision, in order to provide the clarity regarding this, it has now been clarified that education cess and surcharge will not be allowed as deduction because it will be deemed to be included in the tax. Are we clear? So tax would include the cess and the surcharge. Clear? Then 40A to A is regarding the wealth tax. 40A to A is wealth tax deduction not allowed. 40A to B is regarding the 40A to B, sorry. Any amount paid by way of royalty, license fee, service fee, privilege fee, service charge, which is levied exclusively on or which is appropriated directly or indirectly from a state government undertaking by the state government, that is not allowed as deduction. Then 48(3) is regarding the TDS on the salaries. 48(3) is regarding the TDS on salaries payable to a non-resident if TDS is not deducted. So 40A1 was with respect to interest, royalties, fees for technical services or any other sum chargeable. 48(3) is specifically for TDS on salaries paid to non-resident if the tax has not been deducted or not paid. If the tax has not been paid nor deducted. Are we clear? Then 40A4 we already discussed some time back. 40A4 we just discussed some time back. What was it? 40A4? 40A4 is regarding any payment to a provident fund or other fund for the benefit of employees unless the effective arrangements are made to deduct the taxes. So payment from PF or any other fund where taxes have not been deducted, then in that case the payment will be disallowed. Are we clear? Then 40B. 40B is regarding the payment of salary, bonus, commission or remuneration to any partner who is not a working partner. So salary or remuneration C, 40B. So any salary, bonus, commission, remuneration who is not a working partner. So any salary, bonus, commission to person who is not a working partner is 100% disallowed. Any payment of remuneration to any partner who is a working partner or of interest to any partner which is not authorized by the partnership deed or not in accordance with the partnership deed. So if you are making any payment of remuneration or interest which is not in accordance with the partnership deed, that will be disallowed. Any salary or remuneration to a not a working partner will be disallowed. Any payment of remuneration to any partner who is a working partner or interest to any partner which is authorized by and which is in the terms of the partnership deed, but which relates to any period falling prior to the partnership deed, for which the partnership deed never authorized it, that will be disallowed. So any period, any remuneration or interest paid for the period prior to the partnership deed will not be allowed. So remuneration or interest which relates to any period for which such payment was not authorized by the partnership deed, then in that case that will be 100% disallowed. And interest exceeding the 12%, interest exceeding the 12% will be disallowed. So interest will be allowed only up to 12%, simple interest. Remuneration is only to a working partner, which is allowed after the period mentioned in the partnership deed. And what is the limit? On rupees first 3 lakh of the book profit, or in a case of loss 1,50,000 or 90% of the book profit, whichever is more, on the balance of book profit at the rate of 60%. So what are the important thing over here? Salary, payment, bonus, commission, remuneration to a non-working partner is disallowed. Period prior to the partnership deed is disallowed. The remuneration or interest which is not in accordance with the partnership deed is disallowed. Interest will be allowed only up to 12% and remuneration as per this particular slab rate. Are we clear? Any doubt? What is the meaning of the book profit? So book profit is defined in the explanation 3. Book profit means the net profit as shown in the profit and loss account for the previous year. Book profit means the net profit as shown in the profit and loss account as computed in the manner laid down in this particular chapter, but without considering the remuneration paid. So means the profit after interest. Are we clear? Also, explanation 1 says that where the individual is a partner in a firm on behalf of or for the benefit of any other person, means an individual is a partner in a representative capacity, then interest paid by the firm to such individual Otherwise, then as a partner in representative capacity will not be taken into consideration for the purpose of this particular clause. So then there will be no restriction. Let's say, for example, if I am a partner in representative capacity, because the partnership is between the HUF, then in that particular case, I am the Karta of the HUF, so I am becoming a partner in representative capacity in the firm. So if one of the partner is HUF, in that case, the HUF can be a partner, but then there has to be somebody who has to be a representative partner. Then I am the Karta of the HUF, I am the representative partner. Then in that particular case, if I am the representative partner, then the interest which is paid to me in a representative capacity, that will be considered under 12%. But if interest is paid by the firm, let's say on my loan, let's say I've given some loan to the firm and I'm not getting the interest as a partner in a representative capacity, that will not come within the limit of 12%. And interest paid by the firm to such individual as a partner in representative capacity and the interest paid by the firm to that person only will be taken into account for the purpose of that 12%. Are we clear? Are we clear? Any doubt? If there is a supplier of USA has submitted wrong TRC and TRC for current previous year was not given till 30th April and due to that TDS has not been deducted. So will this be disallowed? Yes, it will be disallowed, whatever be the reason. So when if the supplier of USA has submitted wrong TRC and the TRC for the current previous year was not given, then TDS should have been deducted as per the rates under the Act instead of the rates as per the treaty, and it will be disallowed if the TDS is not deducted. Jacob, 40A5 we did it, right? Okay, 40A5 we have not, sorry, I have not done that. It is tax paid by the employer where the tax is considered as the perquisite of the employee under 1010 CC. So tax is of the employee, but it is paid by the employer, then that will not be allowed as deduction. Clear, Jacob? Aniket, how to remember each section? It is with the practice. You revise every time with the section numbers, you will remember. Amount paid to non-working partner will not be allowed as deduction. So that will be added back. Clear, Vinay? Okay. Then 40B we have covered. Explanation 1, as I said, is for the representative capacity. 40BA is for the AOPs. BA is in the case of AOP or BOI, any payment of interest, remuneration or commission will not be allowed as deduction. So interest, bonus, remuneration, commission to member of AOP or BOI not allowed. Are we clear? So in the case of AOP or BOI, any payment of interest, salary, bonus, commission, whatever, that will not be allowed as the deduction. Clear? Then in that particular case, then in respect of 40, C and D are omitted. So that is not there. So we have complete the 40 section also. Clear? Any questions you have? Any questions? Okay, if there are no further questions, we'll move on to quickly to the next section, which is 40A2, which is 40A2. So in case of 40A2, what is covered under 40A2 is a related party transaction. Is a related party transaction, right? One second. I think there's some error. Are you able to see the screen? Okay. Yeah. So 48.2 is in the case of the related party transaction. In case of related party transaction, if the amount is excessive, then in excess of the fair market value, that will not be allowed as the deduction. So 40A2 is for the related party payments. In that particular case, in 40A2, you have to consider what is the fair market value. So where the assessee incurs any expenditure, under 40A2, which in respect of which the payment has been made or is to be made to a related party, and the AO is of the opinion that such expenditure is excessive or unreasonable having regard to the FMV of the goods, services, or facilities for which the payment is made, or the legitimate needs of the business or profession of the assessee, or the benefit which is derived by that particular payment, then the excessive expenditure will be disallowed to the assessee. Then the excessive expenditure will be disallowed to the assessee. So this is what your 40A2 section says. Now under 40A2, if you see, what is the definition of the related party? That is clearly given under 40A2. So if you see the definition of the related party, then in that particular case, for the individual, it is the relative of the assessee. And relative of the assessee has been defined. Relative of the assessee has been clearly defined therein. So in case of the individual, it is the relative. In case of the firm, AOP or HUF, it is the director, partner, member of the association or family, or any relative of such director, partner or member. An individual who has a substantial interest in the business or profession of the assessee, or any relative of such individual. All right. So in case of 40A2, if you see, I'll just put it over here. For your benefit. So that you can see the definition. See, this is the definition of the persons. Individual, it is the relative. And in case of company, firm, AOP, it is director or their relatives, partners or their relative. Individual who has substantial interest, and who has a substantial interest. For this purpose, a person shall be deemed to have substantial interest in a business or profession if, in a case where the business or profession is carried on by company, such person is at any time during the previous year the beneficial owner of the shares, carrying not less than 20% of the voting power. Beneficial owner of shares carrying not less than 20% of voting power. In any other case, such person is at any time during the previous year beneficially entitled to not less than 20% of the profits of such business or profession. In case of a company, firm, AOP, HUF having a substantial interest in the business or profession of the assessee, or any director, partner or member of such company, firm, AOP, or any relative of such director or member or the other company carrying on the business or profession in which the first company has the substantial interest. In case of a company, firm, AOP or HUF of which a director, partner or member has a substantial interest in the business or profession of the assessee, or any director, partner or member of such particular company, firm, AOP or family, or any relative of such director or partner. So which means that in case of individual, it is relative. In case of company, firm, AOP or HUF, It is the director, partner, member. It is a relative of director, partner or member, or any person in whose business the director or the relative of the director are interested, or any other company carrying on the business has the interest in the other company. Are we clear? Then last one is all the associates who are carrying on the business or profession. Any person who carries on the business or profession where the assessee is an individual or relative has a substantial interest in the business of the other person, or where the assessee is a company, firm, AOP or HUF, or any director of those which has a substantial interest in the business or profession of the other person. So where all the assessees are carrying on business, any individual having the substantial interest, any company having the substantial interest, or a company whose director, member or partners have the substantial interest in the business of the other, then all these are the related parties. Clear? All of these are the related parties. Vinay, I didn't get your doubt. In the explanation of book profit, it is written to payable to all the partners. So are you asking about what will be the book profit, right? For the purpose of 40B explanation. So book profit means, yes, the net profit which is computed in the manner laid down in chapter 4D as increased by the aggregate amount of remuneration paid or payable to all the partners of the firm. So that's what I'm saying, that the remuneration, if it would have been allowed as deduction, that will be disallowed. That will not be allowed for the purpose of computing book profit. It will be added back. It will be added back. Are you clear, Vinay? Okay. So that is about 48.2. Now moving on to the next section, which is 48.3. So 48.2 is for the related party transaction and 48.3, which is for the payment basis. Sorry, 48.3 is for the payment in excess of 10,000 rupees. So payment in excess of 10,000. So 48.3 is with regard to the payment in excess of 10,000, which is cash payment. Greater than 10,000. Clear? So in case of the payment or the expenditure for which payment is made in cash in excess of the 10,000 rupees, then in that particular case, the payment will be disallowed. So where the assessee incurs any expenditure in respect of a payment or aggregate of payments made to a person in a day, otherwise then by account pay check or bank or account pay bank draft or ECS or the electronic mode exceeds 10,000, no deduction shall be allowed. Now, for the electronic mode, there are different electronic mode, RTGS, UPI, all of that are notified. So credit card, debit card, all of that is notified. And if the payment is by other than that mode, then payment made to a person in a day greater than 10,000 will be disallowed. There is also section 48.3A, which is similar, but it is in respect of the past year expense. So 48.3A, this is in respect of the last year expense. What does it say? Where the allowance has been made in the earlier year in respect of any liability incurred by the assessee for any expenditure, and subsequently during any previous year, in the subsequent year, the assessee makes payment in respect thereof by an account paid check. So let's say in the last year, I had incurred the expenditure, I had taken the allowance of that expenditure. In the next year, I'm paying that expenditure in cash because that was outstanding. And that is exceeding 10,000 and it is otherwise done by account paid check and all those electronic means. Then the payment so made shall be deemed to be the profit and gains of business and accordingly chargeable to income tax as the income of the subsequent year. as the income of the subsequent year. So 48.3 is for the current year. This is for the payment of expenditure of last year. Are we clear? Are we clear? Then there are certain exceptions to 48.3 and 48.3a. What are those exceptions? So payment made to government. These exceptions are given under Rule 6DD. These are the exceptions given under your Rule 6DD. And these what are the particular exceptions to that? It does not apply to the loan transactions because advancing of loans or the payment of principal amount of loan does not constitute an expenditure deductible in the computing the taxable income. All of this is given in your module. Payment made by the commission agents for goods received by them for sale on commission or consignment basis, because such a payment is not an expenditure which is deductible. Then the exceptions which are mentioned in the Rule 6DD, payment to government, payment to RBI, SBI or any other cooperative bank, payment made by arrangement of letter of credit or telegraphic transfer or bill of exchange, where the payment is made by way of adjustment against the amount of any liability, payment made for the purchase of agricultural or forest produce, animal husbandry, fish or fish products, horticulture, payment made for the purchase of the products manufactured without the aid of power in a cottage industry, payment made in a village or town which is not served by any bank, payment made to an employee of the assessee in connection with the retirement or resignation or any termination payment on account of gratuity or any compensation, so any terminal benefit which does not exceed 15,000 rupees. Payment made to the assessee, payment made by the assessee to the employee after deducting the TDS, where the employee is temporarily posted for 15 days in a place other than his normal place of duty on a ship, and there is no bank in that place or particular ship. Where the payment is made by any person to his agent who is required to make payment in cash for goods or services, payment made to the authorized dealer, all that are not covered under 48.3. These are covered under the exceptions under Rule 16. Then we have already covered disallowance of provision for gratuity under 48.7. We have already covered. We have covered contribution by employers to funds or trust under 48.9. So all of that is specifically covered. Are we clear? So we'll stop here for today. We are left with specific deductions. We are left with 43B. So in the next class, we will start with 43B. We will start with 41, the remaining part of it. So these we'll cover in first half an hour. Then we'll move towards the specific deductions. Are we clear? Any questions? Are you following this chapter properly? Because this is very, very important chapter. And I want you to revise it, please, properly, because this is extremely important. The more you will revise, the more you would be able to, solve the questions. Okay. So thank you so much. See you in the next class.